So today we're going to talk about everybody's favorite topic.
Taxes.
I'm just kidding. Nobody wants to talk about taxes and nobody wants to pay taxes. But we're going to talk about capital gain taxes to help you understand when you have built significant increase in value in your home, what's going to happen when you sell. So historically, if you own a home, especially here in the Bay Area for at least 5 to 7 years, you probably have seen an increase in value, significant increase in value, and that increase in value is called home equity. If we look at this chart over here, in Bay Area's 5-county, median home prices have grown from 1984 to 2022 as much as 300 to 400% in home equity. And that's a huge increase in your asset. So many of you may be thinking about moving out of the area, maybe downsizing. What's the capital gain taxes look like? So today we're gonna go into that. So if you have lived in the property for more than 2 out of the last 5 years, you could claim what we call a tax exclusion. Individually, anybody could claim a $250,000 tax exclusion. And as a married couple, you have a tax exclusion up to $500,000. And what that means is that the difference in the growth in the value, you don't have to pay capital gain taxes up to $500,000 for a married couple and up to $250,000 for a single tax filer. So that's money you could pocket to put towards a down payment for your next purchase. Or you can just keep it in your bank's account for rainy days. Do whatever you want. That's tax-free money from your home. When you sell, you could just keep for yourself. That's the biggest benefit that Uncle Sam has created. It's called tax exclusion. And let me just kind of remind you that you have to live in the home for at least 2 years out of the 5 years to qualify for this wonderful tax exclusion. Any amount outside of that is subject to capital gain taxes, and we're going to get into that later. So if a home is used as an investment property, you have keep it as a rental property for more than 3 years, then what you could do when you sell is to do a 1031 exchange. And I actually did a video some time ago, and check this video out right here to learn more about how 1031 exchange works. But in a nutshell, 1031 exchange is a tax deferred vehicle. So instead of paying capital gain taxes upon sale, if you sell the property and buy another property, you could move that money to the next property called replacement property and defer the capital gain obligation till later. So that's called 1031 exchange. So you can use that as well. So after you have claimed your tax exclusion, or if there's leftover in the sale that you didn't use in a 1031 exchange, that amount is subject to capital gain taxes. Capital gain taxes is generally 15% for individuals that makes $445,850 in annual before tax income. So if you make less than that, your capital gain tax is 15% and 20% if you make over that. So just, be aware that that's your tax obligation. And then outside the federal capital gain taxes, which is 15% or 20%, you also have state capital gain taxes. And depending on the state you're located, here in California, the capital gain is treated as ordinary income. So the same bracket as your normal income, you will be taxed based on that bracket. It's between 1 to 13%. So let's talk about real examples. What does capital gain taxes look like? So let me take my client as an example. He bought his home in 2019, just a few years ago, for $1.3 million. And he spent about $100,000 in capital improvement. And capital improvements are any renovation, most of the repairs, or any replacement of furnace or appliances that you have done to the house is considered capital improvement. So he spent $100,000 in renovating the kitchen, renovating the bathroom, and then replacing the furnace and replace some of the kitchen appliances. And he just sold the home for $1.9 million. So he had a gain of $1.9 million minus $1.3 million, which is the price he bought it for, minus the $100,000 that he spent in capital improvement. So he had a gain of $500,000 in 3 years. That's not bad. It's actually really good. But out of the $500,000, because he is a single person, he could deduct $250 from that amount to be excluded from capital gain. So the amount he had to pay capital gain is the other $250,000. So 15% of the federal, tax rate is $37,500. And then in California, he falls under a 9.3% bracket. So he's paying the state capital gain taxes at $23,250. So his total capital gain for this year, when he sold his home, 2022, his capital gain taxes is looking at paying about $60,750. That's actually not bad. It seemed like a lot of money, but consider he made a gain of $500,000 on his property. He had to pay $60,000 of tax, which is not bad. Still a really great return in my opinion. If you want to know more about how 1031 exchanges works, check out this video right here.